This is ACC Amit Kumar, and we'll use the Ifrs framework for understanding how the assets standards are built up or liabilities standards are developed, how the items are recognized in the financial statements. So the framework defines the accounting under IFRS. The framework defines assets, liabilities, equity, income, and expense. Any accounting which is done anywhere in the world is based on these 5 elements of accounting. Once we know the definition of an asset, once we know what is to be included in the value of an asset, what value we can record in the balance sheet, it is all guided through the framework and the definition given in the framework. And framework is the basis for developing all the standards based on IFRS. Look at the presentation of financial statements. Framework provides the general principles upon which accounting standards will be based. They define asset, liability, equity, income, and expense. So definition of an asset in IFRS will be referring to these 3 requirements of recording an asset. It should be an item controlled by an entity. Control means you are able to direct the use of it, you know how to use it, how you're going to receive benefit out of it. And it is as a result of past event, either you purchased it or either you constructed it, and you're going to receive economic benefits out of it. It can be reliably measured. If you meet all the conditions, you can record the asset into your books. Liability is an obligation as a result of, there's a present obligation you're liable to pay today as a result of past event and from which future economic benefits are going to flow out to the entity. There will be some outflow of resources out to the entity. You're taking a loan, you're required to repay. You are also required to repay the interest component on it, and the interest component will form part of your P&L. The net worth of the entity is known as equity, the residual interest. In layman's language, if you sell off all your assets and after you pay off all your liabilities, what is the remaining amount is belonging to the shareholders of the entity. That is the residual interest, also known as equity. Income is increase in economic flow to the entity in terms of the principal revenue generating activity. You are engaged into some activity which result in increase in income other than contributions from equity participants. It is enhancement of asset or decrease in liability. Enhancement of asset means there's a gain on revaluation which you show as part of your other comprehensive income, or there's an interest income which you're earning. If your principal activity is earning interest, then you can show it as part of your operating activities. You may earn other incomes as well which are not your principal revenue generating activity but add an enhancement to the asset. You become eligible to receive that money from outside participants because of providing some good or service or earning on your investments is also income. Revenue is generated from your principal revenue generating activity, the business you are engaged in. If you're into the business of selling cars, you generate revenue by selling cars. If you're into the business of providing service, suppose BB Cars is an authorized car dealer and they also provide service through their authorized service center apart from sale of cars. Can we say that these 2 are principal revenue generating activities, or I'll consider only one as principal revenue generating activity? What do you think? Can I consider these 2 components, sale as well as service, as principal revenue generating activities of a car dealer?
Only sale of cars will be principal.
But if service is being sold separately, if they're charging the customer separately for those services, and whenever the customer
then that is also principal activity.
That is also principal revenue generating activity. So it depends on what is their principal revenue generating activity, and if they're engaged into this, they are required to show this as part of their revenue. But if they're simply acting as agents on someone else's behalf, so they are simply facilitating this, then they'll simply recognize revenue on net basis. They'll not be able to recognize revenue on gross basis. This we'll discuss in detail when we're discussing IFRS 15, revenue from contracts with customers. As far as financial statements are concerned, we were preparing balance sheet, P&L, cash flow, and schedules in the form of notes to accounts. Under IFRS or IndAS, we are required to publish 4 statements, and anything which we could not publish in these 4 statements, we'll be disclosing them in the notes to accounts. We'll be requiring to publish statement of financial position, statement of P&L, and other comprehensive income. I'll talk about what is other comprehensive income as I progress. Cash flow, so there's no difference in statement of cash flows. It is similar to what we were doing earlier. There's one more statement that is additional, that is statement of changes in equity, which was earlier part of the balance sheet. There's a separate statement, changes in equity, which talks about what are the components of other comprehensive income. Now, if you notice here, P&L is the income of the year. The result of the P&L or profit for the year gets added to retained earnings as part of equity. The components of other comprehensive income are other components of equity shown separately in statement of changes in equity. They are revaluation surplus or fair value through other comprehensive income of a financial instrument. It can be unrecognized actual gains or losses. They all form part of equity in a separate statement known as statement of changes in equity. The objective is to achieve comparability with own financial statements and with financial statements of other entities so that the analysts or investors could analyze these financial statements for taking better informed decisions. General purpose financial statements. Now, these financial statements are not prepared for a particular individual or for the management. Management can demand any report they wish. General purpose financial statements are published in such a manner that whosoever is interested in the entity, they can tailor it to their needs and can take economic decisions on the basis of financial statements. They provide information about the present status of the company, and they also disclose all the relevant information which can help them take better decisions. Different titles may be used, that instead of statement of financial position, we may use balance sheet as a title. All the components are to be presented with equal prominence. There is no concept of ordinary or extraordinary in IFRS or IndAS. And other reports can also be published, which are not mandatory to be published, but if the entity feels that they will add value and this will provide more information to the investors or analysts, they should provide those additional reports as well, but it's not mandatory. The structure is that IFRS doesn't prescribe any structure. There is no format, but they give minimum line items to be included as part of the balance sheet and income statement. Minimum line items are though prescribed by them. Additional headings and subtotals should be used. And if they're using some additional headings and subtotals, then they'll have to use it consistently year on year, not only in the current year balance sheet, but also in the previous year and comparative balance sheet, whichever balance sheets they're presenting, it should be consistently followed. They can classify their balance sheet in terms of current, non-current distinction or in the liquidity order. If you're a bank or a financial institution, order of liquidity will be more fairer presentation than current, non-current distinction, or you can use a mixed basis. Whatever gives fairer presentation will be the basis of presenting these financial statements. An entity can classify any asset as current if they believe that it is going to be realized within 1 year, that is in a span of 12 months. You intend to sell it, consume it in the normal operating cycle. You're holding it primarily for the purpose of trading, and it is equivalent to cash. Cash to cash equivalent in IFRS terms is cash is known amounts of cash in the bank or as denominated in your currency. If cash equivalent is something which can be converted into known amounts of cash within a span of 3 months, which has a maturity period of 3 months or less. Normal operating cycle doesn't mean that it has to be 12 months. Normal operating cycle can be more than 12 months. If you are selling aircrafts, it may take more than 1 year to sell an aircraft. If your normal operating cycle is 18 months or 24 months, for 24 months, you can show it as part of your current assets in the form of your inventories, because that is the normal operating cycle for you. So it's not necessarily restricted to 12 months only. Anything other than them will be shown as part of your non-current assets, which are going to give you benefit for more than 1 year, or you're going to realize it beyond 1 year. Liability, the amount which you're going to settle within 1 year, you're holding them purposely for the purpose of trading, or it's part of your normal operating cycle, that your trade payable period is part of your normal operating cycle. If it's taking more than 12 months, if that's a process which you have been following and that's part of the industry, then if your normal operating cycle is more than 12 months, you can still hold it as part of your current liabilities. And you do not have any unconditional right to defer it beyond 12 months. You have to show it as part of your current liabilities, means you're going to settle them. Normally assume that you're going to settle them within 12 months are shown as part of your current liabilities. Anything other than them is your non-current liability. Now, the word entity does not have an unconditional right to defer settlement of the liability for at least 12 months of the reporting period. There was a difference between IFRS and Indian GAAP on this, and we have maintained one of the difference. If I show you directly the difference, look at the difference. Breach of material provision of long-term loan. According to IAS 1, if there is a loan which is repayable by the end of the year, it was classified as non-current till now, but if you're liable to pay, you have to reclassify it from non-current to current. And if the loan will be classified as non-current if the lender agreed by the end of the reporting period, that our reporting period is 31st March 2019, if the lender has agreed to roll over this finance or has agreed to refinance before 31st March, we can continue to classify it as non-current. But if the lender has not agreed, if the lender agrees after the balance sheet date, after 31st March, we will reclassify it from non-current to current. In India, we did not agree to this. We said that if the lender agreed even after the reporting period and before the approval of financial statements not to demand payment, we'll continue to show it as part of non-current assets. Non-current liabilities will not show it as part of non-current current liabilities. So there is a relaxation taken by IndAS that if there is a liability which is supposed to be repaid on the balance sheet date and the lender has not agreed, then it has to be classified as current liability to be repaid within 1 year. But if the lender agrees after 31st March and before the financial statements are authorized for issue, IndAS says that if this happens, we would like to continue to record that liability as non-current liability. We do not wish to reclassify it as a current liability because this has been refinanced and rolled over. This is the difference between IFRS and IndAS. So these are small minor differences where IFRS differs from IndAS. Hope you got this. Anyone having any doubt in what I talked about?